Hi, I'm Mr. Simons, and in this video we're going to look at recent trends in Australia's inflation rate. We're going to go from 2007 to 2022 and annotate things along the way. So the graph I'm going to be annotating, that's in the show notes below. Let's get started. So in terms of looking at this graph, what I've done is I've labeled 2007. It wasn't initially on the graph there, and that you can see that we go all the way to 2022. I just want to make it clear in terms of this graph that we're very much looking here at core inflation. I'm not looking at the headline rate. My focus is very much on the underlying, because this is what the RBA focuses on. What I'm going to do is I'm going to split up these time periods, so that what we'll do is we'll start by sort of putting a line in between this large increase here. So, and that sort of roughly correlates with 2008. So what I would say on this side of the graph here, that in terms of that, you can see that core inflation was going up and up and up and up. And here what we are seeing is the mining boom. I call it like Mark 1, well, not my designation, I'm not sure where I got it from, but like part 1. And so what we're seeing with this mining boom there is very strong demand, increasing demand for Australia's exports. And there's a lot of economic growth that is taking place. And so we're seeing rising prices in terms of things across the Australian economy, and things are going up and up and up in terms of the overall level of inflation. That in terms of thinking about this more broadly, that this is taking place during a time of rising economic growth. The economy, the Australian economy, is doing quite well, in large part thanks to the strong demand for resources from China. And so that's kind of how I would characterize that period, that we've got strong demand from China, so we're seeing rising prices across a range of sectors, and also for inputs in terms of businesses. So this kind of cost push inflation side of things as well, because if everyone's growing and they're all competing for those same inputs, that is going to result in higher prices. So if we zoom out a little bit, we can see that to the left-hand side of this is that mining boom, Mark 1, sort of cost push, demand pull induced inflation. Why don't we just add that down? Maybe we'll choose a different color there, that what we can say with this mining boom Mark 1 here, that what we are seeing is a combination of demand pull, and that would relate to rising incomes, and that here also cost push, and that would be relate to those input prices. And I'll just link that to the point we made over here, those rising prices across a range of industries. In terms of what happens next then, we've got this period of time, we'll probably we divide it up in terms of things around about when it starts to resume its increase here. And that what we can see here is that core inflation is decreasing drastically, that there's some kind of huge shift that has occurred here. And so that in characterizing that this is the global financial crisis. So that whole world economic downturn that definitely involved Australia, although important to note, Australia did not fall into recession during this period. But with here, what we are seeing is that global economic slowdown, also the decreasing demand for Australia's exports, and that in terms of combining these things together, we're looking at rising unemployment and falling aggregate demand during this time period. So the price pressures that were present in terms of that first period of time, so we'll just we can label that as phase number 1, and we can label this as phase number 2, that it's really kind of opposite, and it looks like it's just reflected on either side the same way, that decline. So what we're seeing here is that a large decline in inflationary pressures. So that kind of covers the first bit of the time periods, and then we'll go back to orange. What we're looking at here is that there is this sort of period of time in which prices sort of rise a little bit here, fall, and then kind of steadily increase a little bit. What we'll do is we'll put a line here as they start to fall again. And that in this third period of time, what we might call this, maybe not to the same extent, is we would look at, okay, so this is kind of like the mining boom Mark II or part 2, but there's also something else that's happening here. What I would also say plus is the GFC spending hangover. What I mean by that is that during the financial crisis, that the Rudd government spent a lot of money to try and keep us out of recession, and that the impact of that didn't just stop at the end of the financial crisis, that it continued. So what we're still seeing over this period of time is we're still seeing the impact of rising government spending that was implemented during the GFC, that it's still having that hangover impact. The other thing that we're starting to see over this period of time is that a global economic recovery of sorts after the real downturn of the financial crisis. So we're seeing global economic recovery, including resumption of China's economic activity, China's economic growth. And remember that China, as Australia's #1 trading partner, that strong demand for Australia's commodity exports. Exports is a component of aggregate demand, increasing economic growth, contributing to a rise in prices. So we're still not sort of at the rising prices of the mining boom part 1, but it's definitely gone back up. So this is what we might label our third period of time. The next period of time is pretty interesting, and that I will put a link to an RBA paper that looks at this particular period of time. What we might do is set it up sort of along this period of time. So looking at this time period across from here till around about here, it's not precise. These are just kind of ranges that we can use to try and understand inflation. And what we would talk about with this stage here is persistent low inflation. For example, if I zoom out a bit, that we're talking about core inflation here, what we can do is just go with this red line and we can say, well, the RBA's target band is between 2 to 3%. And you can see that over this time period, if this line here is 2%, that for a substantial amount of time, actually inflation is below the target band. It is very low over this period of time. So we're calling this the fourth time period. And what you might then ask is, you might say, well, like, why is inflation so low over this period of time? And with that RBA paper that I'll leave in the comments, there's a couple of reasons that I would give here in terms of thinking about. With this period of time, there's slow wages growth, and that's not going to increase prices because firms aren't having to deal with higher wages by then increasing prices to cover those higher wages. That's not something that has to happen. That's part of the reason why prices are remaining low. The other thing we can think about here is that there is a lot of competition in the retail sector, increasing competition in the retail sector, including from overseas, brands coming into Australia and selling their products. And so this will keep prices low in the sense that more competition, increase in supply will reduce prices, including from overseas entrants. So that's something that's taking place at this period of time. The other thing we can talk about here is that new dwelling costs, like new house building costs, that they are relatively low And that was after sort of higher costs during the mining boom periods when there was a lot of demand for construction activity. So now it's a bit cheaper because there's not so much demand in responding to global economic growth. And the other thing which is important in terms of looking at housing is that here is that rents are relatively low. And so when the Australian Bureau of Statistics is calculating the CPI and looking at housing costs, it can say, well, rents are relatively low, so that's not going to be pushing up prices either. So here we've got sort of 4 reasons that the RBA talked about in terms of why was inflation so low during this period of time. Let's say we look at this period here and we'll call this point A, and we'll put A down here. And then we'll look at this period before COVID-19 hits, and we'll call this point B, and we'll put B here. What we can do is we can think about, well, what was the cash rate during these period of time? So before this low inflation period starts, and then at the end of it. So if we think about point A, let's say that that is February 2014, and the cash rate was 2.5% at that period of time. If we fast forward to point B, which was December, this is December 2019, that the cash rate here was 0.75%. So what we can say is that actually the RBA was responding to these low inflationary pressures by reducing the cash rate and trying to speed things up to get the economy going. So let's wrap up this video and look at the last section here. So here, no prizes for guessing what this part here. So this is COVID-19. And we can say plus the after effects being 2 words. So that what we can see in terms of looking at it is that when COVID hits, that we have this period of low inflation here. So we can think about, okay, so we've got lockdowns, so people can't spend as much. We have a decline in consumption, and that also during this period of time, we have a rise in unemployment, which is going to lead to a fall in people's incomes. So those are all that these factors here, that they will reduce inflationary pressures. So that's what COVID brings about. What's interesting then is to think about this next little bit here, where this large jump in inflation. And remember, this is core inflation. This is excluding the volatile components. This reflects the underlying trend. So if we're thinking about this particular element here, 2022 and this rise in inflation, that what we're seeing is a couple of things that are worth mentioning. So yes, we are seeing the kind of ongoing effects of government spending and stimulus that were put in place to try and deal with the worst effects of COVID. But the other thing to think about is we've got cost push inflation because of the supply shortages and the border restrictions. If we restrict supply, which has been the case in not being able to get all the goods from overseas, that is going to lead to higher prices. If the goods can't get to us due to these border restrictions, that's also going to have a similar impact. You can see that here, that when we start in terms of going back to 2007, that actually inflation was rising quite strongly. And then we move into the financial crisis. So here we're sort of looking at late 2008, sort of 2010 in terms of those after effects. We've got that mining boom period of time. Here I might think about maybe 2011 to around about 2014. These aren't going to be precise, but they just give us a way of dividing this up. Here, in terms of this persistent low inflation block that we might think about here from 2014 to 2019, that's sort of pre-COVID. And then here, COVID hits and we're looking at this rising inflation period of time, that 2020 until 2022, our current time period. Okay, so the next thing you should look at is to make sure you are cluey about the types of inflation, and you can get there by clicking on the video that's right next to my face. Thank you very much for watching.